Hello, everyone, and thank you for joining us. My name is Samantha Johnson, and I am the Assistant Director of Alumni Engagement at the University of Colorado Boulder's Leeds School of Business. Leeds is a top business school offering undergraduate, MBA, MS, and PhD programs, and has an alumni network of over 41,000 strong living and working around the world. We're excited to have Corey Finney presenting on Early Stage Startups 101. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask, please send those questions through your chat interface. I will monitor questions as they are submitted, and they will be answered throughout the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants later today, along with a survey link. Now, I'd like to introduce today's speaker, Corey Finney. Corey is a sixth-generation Coloradan and third-generation Buff. He graduated from Leeds School of Business with a finance degree and entrepreneurship certificate in May 2012. While at CU, Corey co-founded and served as CEO of Snowgate, a venture he led from idea to eventual exit in 2015. After his journey as a founder, Corey joined the Boulder-based accelerator program Boomtown, where he served as entrepreneur in residence and taught startup finance and fundraising to over 40 companies. Today, Corey is a founding partner of both Cocopelli Capital and the Greater Colorado Venture Fund. Welcome, Corey, and thanks so much for being here.
Thank you so much for having me. I look forward to the next hour. I guess to get started, why don't we just go ahead and move on to the agenda. I thought I'd provide a little bit of a high-level overview on this chat, and as Samantha shared, please feel free to shoot questions our way throughout the session. I'm more than happy to take a break anywhere, especially if there's interest, and answer the questions that you all have outstanding. So a couple high level things that we'll try and go through. I think most importantly, what I often get asked is just where do I begin? There's so many unknowns, so try and tackle some of the base building. What should I expect? I think everyone has heard that being an entrepreneur is very challenging. But what does challenging actually mean? What are the highs? What are the lows? I'm committed to starting a business. Now what do I do? Kind of what are the first tactical things I need to start thinking about as I am beginning my career as a founder or entrepreneur? Lastly, I want to leave everyone with a couple common mistakes that time and time again I've either made or have come across in various companies that I've worked with. I've been fortunate now, as of today, to have started and sold one of my own companies, but I now am fortunate to run 2 venture capital funds, have investments in over 25 different companies, mainly in the Rocky Mountain region, and through my time at Boomtown was able to review thousands of companies and work hands-on with over 40 companies. So we'll do my best to part some of the learnings I've had throughout my career with everyone today. I think a lot of what you'll find is there's often not a template or a roadmap for startups and entrepreneurs. And I think that can be frustrating because you just want the answers and you want the playbook on how to execute. So a lot of my presentation is going to end up being centered around more of what not to do, and leaving, hopefully, being able to strip away what not to do can help clarify the path of moving forward and what you can do. So to begin, I want to start off with a poll real quick, and I will go ahead and let Sam launch that poll.
Great, thanks, Corey. Okay, so this first poll is, we'd love to get a gauge for who is in our audience today. So I am currently starting a business, looking for my next opportunity, considering a move away from the large company I work for, or just curious. Looks like we've got about 50% of folks who have made a choice here, so we'll leave it open a little bit longer. All right, Corey, and results are in.
Great.
So we'll go ahead and share those out. So as you can see, it looks like we've actually got a pretty even audience here. So most folks are just curious. And then it looks like evenly split. We have some folks who are currently starting a business, looking for their next opportunity, considering a move away, and also someone else has provided that they are a consultant in the entrepreneurship world and
Great.
work with business owners and startups.
Great.
So I'll go ahead and close that and hand it back to you.
Awesome, thanks. That's really good context setting. It's always nice to know who you're chatting with. And we'll try and keep that in mind, that we have a pretty diverse and rounded audience as I go through this. So, first of all, where do I begin is the question that we often come across. And, every great business starts with an idea. And ideas can take many shapes, forms, but I think what's really important is that you shouldn't be afraid to share your idea, generally. And I don't necessarily mean go share your idea with everyone, throw it up on Facebook, run to your nearest competitor, tell them what you're doing, but be conscious and be thoughtful about who you share it with. I think there's a really great podcast called How I Built This, and if any of you are familiar with it, there was an entrepreneur on there who founded the company Spanx. And she said, for the first year, I didn't share my idea with anyone. But what she meant was I didn't share my idea with anyone outside of, I didn't share my idea with anyone inside of my personal network. So she didn't share it with friends. She didn't share it with family. And she did that because she wanted to be able to get unbiased feedback. She instead went and she was sharing her idea with potential manufacturers and with legal partners who could help her, and with patent attorneys. So she was sharing her idea with the right people, and very conscious about avoiding any outside influences who could put a negative bug in her ear and say, you can't do this, that's stupid, spend your time elsewhere. She wanted to make sure that those distractions were out of her life, and I think that that's a powerful story. And one that everyone should consider when beginning a business is, ideas are pretty much worthless until they become action. And so you need to be able to share the idea to have it begin turning into action in any form. Secondly, have a great idea. The chances are somebody else has had that idea, right? How many times a day or a month do you say, oh man, I've got the next best idea. I've got a great idea. Unfortunately, I hate to break it to you, you're probably not alone. Everyone has those aha moments. And so it's important to figure out who else is doing it. What other competitors are currently building this business or a form of this business? All too often, I come across companies and they have an idea and we have a 30-minute, hour-long meeting. We sit down, we go through it, and I'm like, man, this is a really great idea, but it feels so obvious. Who else is doing it? And the founder will say, no one else is doing it. And then I will go spend 30 minutes doing research, and I will find that in fact there's dozens of other people who are doing something similar or the exact same idea. And not doing your homework on who else is doing it is, I think, a pretty easy way to shoot yourself in the foot out of the gate. It's a little naive to assume that you're the only one with this specific idea, right? What it comes down to is the execution around it. Can you execute on the idea better than your competitors? And that's the hard question I think you need to ask yourself, and you really need to be able to understand the competition to answer that honestly for yourself. Before jumping in too deep, I also encourage everyone to do the 10-year test. And the 10-year test is pretty simple. am I going to be excited to get out of bed 10 years from now spending my time on this idea? If the answer is no, then you probably shouldn't do it. Startups are challenging, and the average time to exit with a startup is 7 to 9 years. So, all the time, again, I come across founders who say, I have a great idea, we're moving quickly, we're going to sell our business in 2 years. And for me, that's almost an immediate disqualification, because a founder who's expecting their life to get orders of magnitude simpler in a 2-year period, that's just delusional, in my opinion, and not idea that I want to be able to get behind. When I invest, it's with a long-term view, knowing that it takes a long time to build a good company. The other thing, why
Corey,
you? Yeah.
We have a question that
Great.
came in about competitors that before we move on. So as you were talking about competitors, how do you best search for answering the question, who else is doing it? What do you consider when looking at other competitors who have a similar product?
Yeah, great question. So I think, first of all, anybody who's doing the same exact thing. So if you type in, Google is a great tool that I think everyone uses for this kind of research. And if you just type in basically keywords around what you're doing, you'll see what pops up. You'll be able to see if there's people who are doing similar, operating in a similar space. And from there, you can kind of figure out if you're differentiated in any way. I think that Angellist is another great resource for entrepreneurs. It's more or less a online social community for startups and investors, and you can go into Angellist and search by different functions. So say you have an IoT company operating in the sprinkler space, you can go into Angellist and look for IoT company sprinkler space, and you'll come across companies like Ratio and several others who are in the space. And then the other thing I think about that I don't think everyone always thinks about is, whose money would I be competing for? So your competitors are really whose dollars are you competing for, and who would you be trying to take market share from? That one could be a little bit more out of the box, but I think if you think about it from that direction, for example, if you're a new ad tech company, you're going to be competing with ad agencies. So they may not feel like a direct competitor, but you're competing for the same budget spend from the companies that you would be looking to win business from. I'll keep moving on, and again, please feel free to hop in if that didn't answer your question or if there's more. The why you piece is really important. Why are you uniquely qualified to be doing this, right? If ideas are a dime a dozen, then why are you the one person who is built and placed to execute on this opportunity and this idea? I think that's critically important. A lot of times we come across founders who want to start something because they want to get rich, and that's a guaranteed no for me, because I want to find a founder who I can believe their purpose is to be pursuing the opportunity that they're working on. Does it solve a true pain? I think that there's a lot of gray area in this one, but are you really solving a true pain, or are you simply making something that's a little bit better than the current solution? Right? We often, what you'll hear in the startup lexicon is, we want to see companies that are having a 10x improvement over what is present today. So, I'll use Apple is a great example. The iPhone was a 10x improvement over the current phone solution that was in the market. Is that pain truly there for the customer? And then lastly, the value of an idea is zero, right? So to kind of sum this all up, ideas aren't worth money, unfortunately, but it's the execution that matters, and it's the steps you take with the idea that turn into value. A little bit on team, going at this alone, where do I begin? another thing that most commonly asked is, do I need a team? And I think that there is not a yes or no answer to this. As you'll find in entrepreneurship, most of the time the answer is it depends, which can be incredibly frustrating. But I've seen great companies built with solo founders. However, the data would suggest that companies that have more than one founder, usually somewhere between 3 or 4, actually have a higher chance of success. And I look at this through a couple lenses. One, being a solo founder is just incredibly challenging. The journey that you're going to go on is emotionally draining, and it's nice to have, other people who are in the boat with you and rowing in the same direction and can take turns. When you start getting burnt out, they can pick up the pace and vice versa. It's good to have people to bounce ideas off of, and to ensure thought diversity. I think is incredibly important when starting a business. Having people who can look at problems from different perspectives is always valuable. It is important to note, though, that when you are taking on co-founders, this is a very long-term relationship. On average, it takes, as I mentioned before, 7 to 9 years to exit. And unfortunately, that is actually a longer time period than the average U.S. marriage lasts 7 years. And I think that all too often people, when starting businesses, they don't look at this as a true long-term investment and long-term relationship. It's very likely that you're going to be working with and spending time with your co-founders for the next 10 to 15, even 20 years if the company is successful. And it's easy to get excited early on, but having those tough conversations is incredibly important in the short term, and can save a lot of time, a lot of headaches down the road. Pause in case there's any questions there. Cool. I'll keep moving. The last thing to consider before
Corey.
Yep. All right.
Sorry, I had a question come in. In your experience and from the companies you worked with, what is your feedback on having good friends as co-founders? Does that get tricky? Have you seen it be successful?
Awesome question. It depends would be my short answer. I think that it's challenging, right? That being said, in 2 of my ventures I work with my brother, so it's certainly doable. I think that it requires you to establish a relationship that is different from your friendship. I don't think that you can just expect to have the same friendship and work on the business, as his friends, because sometimes you're going to disagree, you're going to be at each other's throats. You're likely going to spend more time with this person than you would anybody else in your life. And so, I think being able to the best of your ability, try and set up some walls around what friendship is and then what business relationships are is incredibly important. I'll use a personal example. My brother is my best friend, but we also set time aside. We spend most of, we're on the chatting throughout the entire week, but we'll set time aside to interact as brothers, and business doesn't come up. We don't talk about it. It allows us to have the duality in our relationship, and I think you need to be really deliberate about that if you're going to do that. Keep moving. So regarding timing, it's also important to ask yourself, is this the right time? And right time on so many levels. Is the market ready for this? Right? You may have a great idea for a social network, but if it was 1998, it wasn't going to be a great idea because the market just wasn't there. People weren't ready to start interacting online with one another in that capacity yet. Right? It took the evolution of the internet before folks were ready for MySpace and then Facebook. personal. Am I ready to do this? Do I feel like I'm in a sound place to take the journey? And what other obligations do I have in my life is important to ask yourself. Are you ready to commit? That's, I think, often the hardest question. It's easy to start doing, but it's can feel all consuming once you do begin doing so. I think it's important to ask yourself if you're ready for that journey. Financially, is it the right time, right? We hear stories of entrepreneurs who make it big and then they go broke and make it big. And I think, one thing to consider is, financially, are you in a position where you can afford to jump in feet first and start this opportunity? Sometimes you don't have a choice and you just begin, and this is your path to financial stability. But there are times where you may be very financially uncomfortable. You may have to rate the Airbnb. There's a great story again on how I built this. They had a book of a working book that they kept of credit cards, and they financed the first $20,000 of their business all on credit cards, just maxing out one credit card after another, and somehow getting by personally as well. So, it's obviously it's a little bit of a personal question of what financial position you're in, and then what do you need to be secure and comfortable there, or do you? You may be comfortable not having a financial grounding. And then what relationships are in your life? And I don't mean this just to significant others, but also, what about the friends in your life? And what about, parents? Do you have the support system in place at that time that's going to be able to help you with this? No company is built by an individual, even if they are a co-founder. Everyone has a team or a support network around them in one form or another that helps them get there. And it's not a bad idea to have that conversation with some of those folks to make sure that they know that you're signing up for this journey and that they're on board to support you. Move on to the next slide here. So what should I expect? I think, I was putting this presentation together and I found the graphic on the right. And to me, I haven't worked in corporate, but from chatting with my friends who are in that world, I think, there's great perks to both sides of the coin, but when we're talking, sometimes, it feels like, yep, a startup is pushing the rock uphill all day, every day, and if you take a break, it rolls back on you. And corporate life isn't all that different in that, you feel on the infamous hamster wheel, right? Some things that I think are specific to note to startups is that a startup is a lifestyle, not a job. So this becomes, what I mean by that is that it becomes your life. Your life gets built around your work. And it's really hard to separate, especially from a personal identity perspective, your work from your individual self. Customers don't sleep, right? So when I was running my first company, we had customers, we had two people, and our customer support line alternated between my cell phone and his cell phone depending on the time of day. And so it didn't matter if I was at dinner with my parents or if I was at a Rockies game with friends. If the customer support line rang, I was on call. So you can live your life, but you need to know that work is always kind of in the background. There's nowhere to point if something goes wrong. It's not your boss's fault, right? It's not that the company doesn't give you flexibility. It's that there's something in your control, and you need to figure out what that is and how to change it. So the only place to point is at yourself. As I mentioned a little bit before, identity can be a challenge, right? You get very caught up and wrapped up in the work you're doing, and it's easy to identify yourself simply as what you do. And I think that can be a little bit different from a traditional job where you may be an individual who goes to work from 9 to 5 and then work stops, and you get back to the individual things that you that encompass your time, friends, learning different things, hobbies. Not that you can't do that, but I circle back to work is always in the back of your mind, and it's always there when you are making the entrepreneurial leap. You can expect the highest of highs and the lowest of lows. There is no better feeling than getting your first customer and having the first revenue hit the account and knowing, man, I worked for a year and a half and somebody finds value in what I've built for the world. That is one of the proudest moments, and I think one of the most exciting times in any entrepreneur's life, along with many others. It opens many doors and allows you to experience some pretty unique things. But the lowest of lows comes back to nowhere to point, right? When something goes wrong, it's on you to figure out how to fix it, and it can be pretty daunting and pretty mentally exhausting when things aren't going well, or when you can't close your round of financing and you don't know how you're going to pay your staff. Other people's livelihoods are dependent on your ability to execute. That can be a pretty challenging burden to take on. So anybody who's thinking about getting into it or who is in it just needs to make sure that their understanding of what they're signing up for and the roller coaster that they're about to go on. I think the best entrepreneurs find space to separate themselves from work and to try and get themselves back to even keel. Even if it's a high or a low, you celebrate your wins, you learn from your losses, but regardless of where you are, trying to be able to come back to a center ground and ground yourself as an individual, I think is incredibly important in terms of having success at the entrepreneurial journey. I think there's another idea out there that being an entrepreneur comes with all types of freedom and control. And my answer to that is kinda. It comes with freedom and control in several ways, right? Schedules are now yours. There is no one saying you have to schedule this meeting or you have to schedule this meeting at this time. There are many great entrepreneurs who have famously, decided that they are going to build their own day the way they want. Notable investors who don't take meetings before 10 o'clock. And that's so in the morning they can kind of go through their routine and ensure that they're building their day to maximize their efficiency and their ability to create output and sustain the high level of productivity. So it comes with freedom in that sense and control over schedules. But you also are again, coming to the point above, you're at the beckoning call of customers. The thought of the business doesn't ever really go away, so you do always have those constraints on you. Responsibility, I've touched on this already, so I won't go too far into it, but with responsibility comes great freedom and control, but is also very limiting because you are accountable, especially if you take on investment dollars. You are now accountable to your investors. You have a fiduciary responsibility to ensure that you are acting in the best interest of the business as an entity. Flexibility, it comes with the territory. There's flexibility to, book a long weekend. The flip side of that is you're going to have to work late and you're going to have to make up for that time. It's not like, starting your own business is a path to unlimited flexibility and unlimited open time. At least not if you're doing it right, in my opinion. I think what it really all comes down to is it forces ownership. There's an incredible book. One of my favorite books is called Extreme Ownership. It's written by former Navy SEALs, and they walk through their thought process of what ownership really is and what it means. And each chapter is broken into 3 sections. They tell a combat story, the lesson that they learned from that experience in the field, and then how they've applied that to a business situation in their consulting practice. And I think it's a great book to illustrate what ownership means and the importance of taking accountability for all of the decisions and all the things in our world that we can control, letting go of the things that we can't control. And I think when you're operating at a very high level as an entrepreneur, you learn to embrace ownership. And by doing that, that opens up freedom and control. If you don't embrace ownership, you feel like you're always playing defense and things are always getting thrown at you, and you find yourselves on your back heels. I'll stop in case there's any questions at this point, just for a sec. Okay, keep moving. The word passion, it's one of the more overused words in startup lexicon, but I think it's incredibly important. And maybe passion isn't the right word, but what's the essence of it is, and that's you need to be all in, and this needs to be your purpose, right? It needs to be your guiding North Star for why you get out of bed and why you're engaging in the morning, evening, afternoon, all hours of the day. It's really important to have a belief in what you're doing if you're going to be able to sustain the output that's required to build a successful company. Financially, early days, don't expect to get paid a lot. Don't expect to get paid. One thing that we see quite often is people coming from other companies and they expect to make $150,000 a year because they're making $200,000 a year at their last job, and so they're taking a pay cut to do this. And all too often, we have to sit down with those companies and revise that and kind of have a little wake-up call. That's just not what we expect to see in the startup world, and that's because all the money that you raise early on is coming from investors, and when an investor gives money to a company, they're expecting to see $1 turn into $10 worth of value, right? That's the famous 10x return. And it's not that the people behind the company shouldn't be supported and shouldn't be compensated for what they're doing, but it's that there's often other avenues in the business where that money just critically needs to go, like running marketing experiments, building product, hiring additional people to help. So we have to have a lot of tough conversations early on about what to expect financially. For many companies, founders don't get paid for quite a while. My first venture was a example of that. We didn't get our first paycheck for a year and a half. We bootstrapped the company and lived off savings. And that's, I think, pretty normal until you raise your first round of financing. When you raise the first round of financing, founder salaries usually are between $30,000 and $60,000. If the founder's done it before and is qualified, maybe it's a little bit higher. Maybe it's $80,000 a year or so. But it's not a path to early financial sustainability. The finance opportunity that a founder should be working for is for the equity position that they hold in the company. And that keeps incentives aligned between investors and between founders to make sure that everyone is trying to maximize the value of the shares of the company. Right? So it's important to note that, as with all finance, it comes back to risk and reward. And it is a massive risk that individuals are taking. Likely that person could be making a lot of money in another role or with another company. But the thought behind it is that they're doing it for the opportunity at a great reward should they build a successful business. And as companies gain traction, I think financial metrics, they begin to normalize to what people would expect as market. And then lastly, your support system. People in your life are going to make sacrifices, whether you recognize it or whether they recognize it going into it. It's important to take note of the people in your life who are making those sacrifices. And it's important to understand that not everyone is up for the journey. and not everyone is going to be able to emotionally support you as you go through this and as you go through your ups and downs and learn the ins and outs of being an entrepreneur.
All right, Corey, we have some questions.
Okay.
If you're up for taking some.
I'm up for taking some.
Oh, great. Okay, so this one is specific to finances. So is it advisable to start multiple new businesses, say 2 to 3 simultaneously? And also, is it advisable if you do have the financial wherewithal and availability?
It's an interesting question. And I think, again, it depends is the answer, but I personally don't think so. I'll hit pause there. Operationally, I've personally found that I operate best when I have 2 projects going on. And if I have more than 2, I don't do well. And if I have just 1, I kind of tend to get bored. So I think what's appropriate is what's appropriate for you. But being able to manage the time commitments is a very real thing, right? So if you start 3 businesses at the same time and all of a sudden one starts taking off and becomes more demanding, are you going to be okay cutting the other 2? Would be my question back to you, or back to the participant. If the answer is no and you're going to try and do all 3 at the same time, I think that's probably ill-advised. But if it's, kind of trying to hedge your bets, then I think that's a different story. What I will say is it's really, really hard to find 3 ideas that you can have that level of passion and 10-year commitment to all at the same time. There are, unique exceptions to that. Elon Musk probably being the most famous example. But it's not something that I would encourage most entrepreneurs or founders, especially first-time entrepreneurs or founders. I wouldn't encourage them to do that. I think it just takes so much energy and focus that it's really hard if you're moving that in multiple directions.
Great, thank you. And another financing question, which we can pause on any of these, Corey, if you're going to be going into more content around this. But how do you value your company when obtaining first round of fundraising? So, in other words, what percentage of equity would you allocate to investors based on a given dollar value?
Yeah, I gotcha. So that one certainly is, it depends, and I should probably throw out the disclaimer that I am not able to give financial advice or guidance, but what I can say is that usually when we see a company raise a round of financing, they end up giving up between 15 and 30% of the company. So you can use that as a rule of thumb in terms of how much equity you should expect to give up each time you raise a round of financing. If you have a lead investor, you have a sophisticated investor who's made some investments and they want to set the terms, that's usually how it's done, is the investor says, okay, here's the terms that I want to give to the company. And then the other investors, the follow-on investors, go with those terms, and that's how it's set. In the early days, it's challenging to set a valuation on a company, so some companies will use a convertible note or a SAFE, which is basically an instrument that you set a cap on what the valuation cap would be, but it prolongs the actual valuation until a subsequent equity round is raised down the road. I think you need to be sure that you're going to raise another round of financing at some point for these instruments to make any sense. Early stage companies, it depends on the market as well. So you can go out and you can find comparables of what other companies were valued at early stages and use that as a reference when setting a valuation.
Great, thank you.
Yeah. Is there any more, or should we keep moving?
So we do have a few more, but I'd like to save them more towards the end,
Okay.
if that works for you.
Perfect.
the next slide.
Perfect, yeah. I kind of went through all this, but and I think that the slide deck will be available. Just wanted to kind of illustrate some of the pros versus some of the cons. I think, it's incredibly fulfilling, and you can get a lot of gratitude out of running your own venture. In my opinion, and this is totally an opinion, there's no better way to learn. There's nothing like jumping in the deep end and having to figure out how to get out. Um, and it's incredibly powerful knowing that something you're building or your idea turned into something, a product, that impacts the reality of others, right? As a founder, what you're really out there doing is you're trying to take an idea, put it in the everybody's present world, and then affect their reality so that they use your idea and it has an impact on their reality. And I think the idea that's just incredibly powerful and obviously, enticing for building a company. The last thing on the pros is doors, and so many doors. And I'd say that from personal experience, the doors that it opens, you can't ever imagine. I think it leads to really interesting and creative paths and journeys if you're up for the challenges. But it always opens up pretty unique experiences, and you get to work with risk-tolerant, incredibly creative people. One thing I was joking about earlier today is that often, in my opinion, a lot of the best entrepreneurs aren't actually risk seekers. They're really good at mitigating risk and acting on it. So I don't think that somebody has to have the daredevil mindset to go and start a company. The cons, I think we've gone through a bunch of these, so I won't spend much time going through them again. And yeah, we can go ahead and move on now to the next poll.
Okay, great. So next poll here, who is eager to begin based off of our conversations? So I love these options that Corey has offered. So you've successfully talked me out of it. Nothing will get in my way. I have some more thinking to do. And this all sounded crazy in the first place. It's just great options. So it looks like we've got about 65% of folks who have responded. We'll leave it open for a few more seconds here. All right, so I'll go ahead and close this and share the results. So Corey, great news. You have not talked anyone out of it. Several people feel like they have more several people feel like they have more thinking to do. There were a couple out there that felt like this all sounded crazy in the first place, but 37% said nothing will get in my way. So cool. I will hand it back to you. That's great. Well done.
That is great. Yeah, 5% is rational. Nice. I like it. No, I'm just kidding. That's awesome to hear. I think the world needs as many entrepreneurs as possible. Well, great. It sounds like most of you are committed and still wanting to do it. So moving on to the next slide, I'm committed. Now what? Right? Some of the tactical advice and things that you can start thinking about as you begin working on your company. What I can't understate, and I, again, am not here to provide legal advice, but get your legal right out of the gate. Don't shortchange on legal. Get a lawyer and make sure that you do things right. A lawyer generally they'll give you a free consultation and they'll tell you what you're going to need, and it's incredibly important to have that hammered out of the get-go. There are some things you can expect to have. Operating agreements, these are the documents that govern the operations of the company. So what needs to be voted on, who votes, how's that go, what happens if there's a dispute, what happens in the event that a founder passes away, where's that equity go. For the most part, these are pretty standard. And with a LLC, there's a little bit more flexibility in operating agreements. With a C Corp, the documents are pretty much taken off the shelf. especially with Delaware C Corps. There's just been so much litigation that it's, which is a good thing in this case because it's, all the unknowns have been answered. And it sounds like, there is another webinar that I know is on CU on entrepreneurial law and employment law for startups and small businesses. So feel free to reach out to Sam if you would like to check that out. Other documents that you could expect: vesting agreements. These are agreements between you and your co-founders. I can't understate the importance of these, of all the documents here. Vesting is so important. When I started my first business, we had 6 co-founders. Within 3 years, when we sold the company, we were down to 2 co-founders. And a vesting agreement is simply an agreement that says, okay, you get a quarter of the company, you get a quarter, I get a quarter, and you get a quarter, but we earn that equity over a period of time. And usually that'll be a 4 to 7 to 10 year period where, let's say, 2 of the employees leave a year into the company, then only a certain percentage of their equity would be vested, and the rest could be bought back or would be returned to the company and used to incentivize the remaining founders or to hire on new employees for the company. So making sure you're protected with vesting agreements is one of the most critical things you can do. Things go wrong. You should expect for them to go wrong and plan for them to go wrong. It's a hard conversation to have, but everyone should be in alignment there starting out. And then company structure. It's important to understand what the best entity structure for your company is. And again, I'm probably not the one to provide the technical legal advice and accounting advice there. The 2 most common structures are C Corps and LLCs. And different companies have different uses or are appropriate for different uses. So chat with a lawyer or an accountant there when you're getting going. Out of the gate, there's a couple best known methodologies and practices. So the Lean Startup, there's a book called The Lean Startup, and I suggest before anyone starts a business that they go out and they read that. It's just a really good template of thought for how to be running small experiments to get to get a lot of data and answers. So for example, MVPs, minimum viable product. What's the least amount of work you can put into a product to get it in someone's hands to get their feedback on it? And get creative, right? So what we would do with companies when I was working for the accelerator is they say, okay, we want to go build this website. Before you even build the website, put together some mock-ups on paper. Don't invest any money into building anything technical yet. Just put together some images on paper and go put it in the hands of potential users and see how they interact with it. It'll save you a ton of time and a ton of money by running experiments like that. And hand in hand with that is engage your customers from the get-go. The customers, right? Often we think we know what customers want, and that's, in truth, that's very rare. The customers will tell you what you want. You need to be able to focus and distill down the most important pieces of the feedback to prioritize what you're building. But that can't be done without engaging customers early and often. Even if you have a hardware product, right? So my first company, we made ski lockers. We interviewed 1,000 people about the idea and with mock-ups and the pain point before we ever built a prototype, a physical prototype. And then when we built our first prototype, we knew we were building the right thing because we had the data to support that. One thing I'll say is that I'm a big believer that you can't be successful or define success if you can't be successful if you don't define success ahead of time. So OKRs are a great goal-setting tool. You can, if you search OKRs, there's a ton of different frameworks and ways to come about establishing these for your companies. But it's essentially the process of setting goals for the company and then measuring those goals, having defined KPIs, right? So what are your key performance indicators that you're measuring against to know if you are in a place of success or if a place in the business needs work. And then how do you make those adjustments as you go? I think following that kind of loop is a great way to ensure that you're getting feedback from customers, you're moving quickly, you know the direction you're heading, and then you can identify when something is out of place and needs some more attention. And then there's a best known practice specifically here in Colorado where Techstars was born, and that's the give first mentality, right? Go out of your way to share something or to help out other founders, to take time to engage people who are curious about what you're up to. Giving first, it always seems to come back, and I can say this from personal experience, it always seems to come back tenfold. I think there's more questions here on do I need to raise money? And remember, I am a venture capitalist. I make my money by investing in startups, and my personal opinion is not if you don't have to. Do not take on money if you don't have to. If you can bootstrap a business and build the business you want by bootstrapping it, that's the path I encourage. Once you take on investors, right, we talk about freedom and control, some of those go away. You have obligations to your investors, and investors want to see you maximize returns. And that can be misaligning if, a founder wants to build a $20 million business, but an investor thinks it can be a $200 million business. Well, the investor is going to push you and may have legal rights to push you to go after the $200 million business. And that business could fail along the way, and everyone's left with zero, right? So in my opinion, financing can be great for the right companies and the right structure, but can also, it takes away from optionality for the founder. If you are going to raise money, there's a couple things to consider. It takes 6 to 9 months to raise a round of financing. Most of that is relationship building. We talk about investing in lines, not dots. So over time, it takes, this is a long-term relationship that you're going to have with your investor, the 7 to 9 year journey that you're getting on together. Investors don't want to just write a check after the first meeting. They want to meet you and get to know you a little bit. So you need to be expected to create relationships before you're going to get people to invest money. Think exponentially. How does $1 turn into $10 worth of value? Where in my company am I going to spend this money to create, exponentially more value? All too often we come across founders who they say, I need $500,000, and we say, why? And they say, well, because. And we say, well, where are you going to spend it? And they say, I'm not quite sure. That's a guaranteed no, because once we invest, we now view the founder as an investor in their own company. I think it's important to find the right investor for the company, and not all capital is created equal. And again, it's all about the relationships. And then lastly, sales solve all, right? So if you need capital, sales help with that. If you need to attract investors, sales really help with that. So when in doubt, turn your attention back to sales, and it can be a great problem solver. We've got 6 minutes left, so I'll run through the startup killer slide somewhat quick here. These are just kind of common known startup killers that come up time and time again. Number one is founder issues. That can't be avoided. They're going to come up. Make sure you have the framework and the respect amongst each other to be able to work through problems. All too often we see founders who obsess with their solution instead of the problem. You need to obsess over the problem. You need to fall in love with the thing in the world that you're trying to change, and be open to the idea that your first solution or your first idea how to solve that solution may not be the way to solve that problem. Overbuilding is another one where we see teams, they go out, they think they know exactly what people need, they build, they spend all their money, then they get it in users' hands and they find out nobody wants it. And they can't go raise money because they have no... And then that kind of goes along the lines of failing to test or validate assumptions. If you aren't If you aren't testing and engaging your users, then you have no feedback to know that you're moving in the right direction. Capital issues is a given issue, especially once you raise your first round of financing. It's really easy to become reliant on outside capital once you take on investor capital. Uncontrolled growth sounds like a great problem to have, but can be a startup killer if growth isn't done in a thoughtful and meaningful way. Lack of market understanding, you don't understand where you're building. Lack of customer understanding, you don't understand who you're building for. And then most importantly, failure to plan. You can plan, you can know for certain that your plans are wrong and going to need to change, but failure to plan will guarantee failure for the company. We have just a couple more minutes, and apologies for rushing through the last slides there, but happy to take any questions here in the final minutes.
Yeah, thanks for all of this great content, Corey. This is awesome for anyone looking to start a business. So I have two questions that I'd love to ask before we get to the top of the hour here. One, you've provided some great resources for folks to follow up on, including books like Extreme Ownership and Lean Startup. Do you have any other readings that you would recommend for someone learning the startup area?
I think Extreme Ownership, Lean Startup are really great. Venture Deals is another incredible book. And then there's some podcasts. How I Built This is a great podcast. Startup is another great podcast. And then I listen to The Full Ratchet is a great podcast on investing.
Thank you. Yeah, that's great. And then the last question here. So this is a question regarding you've started your business. When, so I love this question because I think there are probably a lot of different answers. When should you pivot or persevere in your company's product?
That's a great question. It depends. So great question. I think if you're just not getting any engagement from users, it's time to pivot or persevere. And I think it's important. I've seen companies pivot before they ever actually get user feedback. And to me, that's more of an issue of fear about going to market and actually committing, and less of an issue of the product or what's been built. So I think, it's also important to know where you're at personally. I had a mentor tell me when I began building my first business, and he said, "You'll never fail, you'll only give up." And I think that that's fairly accurate and quite appropriate. And what I would add to that is sometimes it's the right answer to give up, right? So, with my first company, we had an opportunity to try and pivot and persevere, and had a small exit opportunity as well, and decided that we just didn't have the energy to keep fighting on, and so we took the exit option. So I think that's more of a personal question and less of a tactical question. It's, do you have the energy and the belief in what you're doing to continue trying to solve that problem for the world? And if the answer is yes, then it's time to keep at it and come up with another solution to the problem.
Awesome. Thank you. Well, thank you so much to everyone for joining us for today's webinar. And Corey, again, thank you for all of this incredible information. You provided some great insights, so thank you. And as a reminder to everyone, to view upcoming webinars and request previous recordings, you can visit our website at www.colorado.edu/business/webinars, and have a great rest of your day, and go Buffs.
Thank you.